Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
It's a little bit after the hour. Good morning. Happy Memorial Day weekend, everyone. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner with Alan Clopine. He is a CPA. Thanks for tuning in. First time listening to the show. We're here for a few hours talking about finances, your retirement, investments, taxes. You name it in regards to personal finance. We try to cover it on this show. If you want to listen to us on our podcast, you can go to iTunes and go to Your Money, Your Wealth, or you can always go to our website at purefinancial.com. Happy Memorial Day weekend, Big Al.
Yeah, same to you. You've got, some family in town to celebrate, I think.
Oh, yeah. Cousin
Nice.
from Tucson.
Good for you.
Oh, it's going to be great.
Yeah, and right after this show, I'm heading out to Colorado.
With
Ryan. He graduated from Boulder in December, and he may want to move back to Colorado, maybe Denver, so we're going to check it out.
Rocky Mountain High?
That's it.
Little John Denver.
Yes, very good. Yeah. You know your stuff.
I do.
Even though you're a young guy.
I do know my John Denver.
Anyway, Memorial Day. It's the day we honor men and women of our armed services who died while serving our great country. And but we actually honor everyone, Joe, those that have made the ultimate sacrifice, our veterans, and those who are currently serving, and we certainly thank you.
Yes, being here in San Diego is where we're based out of, but we have offices all over Southern California. And it's pretty special to live here in San Diego. One of my best buddies is in the Navy, so I always hear of the interesting stories.
Sure.
And we definitely thank everyone for serving today, and that have, of course, made the ultimate sacrifice.
Yes,
so.
Yeah, and it's for their sacrifice, Joe, that you and I are sitting here today.
That is correct, my friend.
Freedom of speech and other freedoms that we possess in the United States. So again, thank you for your service.
Talk about freedom for having a couple of clowns like us on the radio for the last 10 years.
Yeah, that is. I don't know. They keep bringing us back.
Well, the door's not locked, so.
Yeah. Remember that one time our key card didn't work?
Yeah.
We thought we were done.
We did. It's over.
Yeah, we got this live show, and both Joe and I show up, and our cards don't work in the lot where we record, and it's like, oh, maybe they are telling us we've been cut.
Maybe they pulled the plug on us. Well, today, what we want to get into is talking about retirement. There's some things that you can't control. There's some things that you cannot control. So we can discuss that, because I think a lot of the focus, unfortunately, are things that we can control. I mean, that we think that we can control, but we have zero control over.
That's true. I would agree with you.
Yeah. I wish I could control the markets.
Yeah. Or I think I can.
Sure.
Just if I buy the right stock or
exactly.
investment, I'm certainly know more than anybody else.
It's funny because I was listening to this behavioral finance professor, and he does a couple of different exercises with his class. And because as humans, it's our human nature to try to predict the future.
Sure.
And he says the smarter the people are, the more educated the people are, the worse it is.
Yeah.
You know what I mean? Because, all right,
sure.
I've been through some life experience. I was able to conquer, some different things in life. And so, all right, well, here, I know probably what's going to happen in the future here. So we convince ourselves that we do know what's going to happen. But unfortunately, no one has that crystal ball.
Right.
And it's challenging when it comes to our investing.
It is. And, you see this from time to time. You see a young person that makes an investment, buys a stock, and it does really well. Okay, great. That's a good start on your investing career. But then they start to get overconfident about, well, I must be a really good stock picker. And then, of course, lo and behold, at some point, they pick one that does very poorly. And it's, and our...
And they attribute that to bad luck.
Yeah, of course.
Not necessarily not skillful.
If it goes up, I'm skillful. If it went down, well, that was just bad luck.
But
our emotions do kind of get in the way when it comes to investing, because we know from clinical studies that the emotion of fear is twice as great as the emotion of elation or joy. In other words, we're twice as fearful as we are on the joyful side. So
we're twice as fearful to lose $1 than we are to gain.
Yeah, and that's the point, right? And so how that kind of messes us up a little bit is we tend to sell our positions when they go down because we're fearful. And what you're doing in that case is you're selling an investment when it's not done well, when the market is down, and then we buy back in when things look pretty good after the market's gone up for a while.
Or even, I guess, to continue with that thought process is that people try to find their holy grail of investment, right? So they do the research, and they'll say, all right, I think this is going to be a really good investment. And then they find out that they might have bought in at the wrong time, and then all of a sudden the investment starts going the other direction than what they want it to go. So they sell it and they buy something different. And that, even though the markets might be up, their particular investment is not doing what they anticipated that they wanted to do.
Sure.
Right? So they keep on getting in and out of different investments, not just getting out of the market because I'm fearful because I want to go into cash, because I think on the greed side there as well is that you're anticipating a certain target rate of return. Well, maybe that particular investment performed, but it didn't perform under, what that individual thought it would. So they sell it and they buy something else. And they sell that when they buy something else. They sell that when they buy something else. Or they hear the water cooler, tips of the day, the Uber drivers giving them investment advice. So it's this, but I get it. I understand, because we all want to make money, right? And we don't want to lose any money to make it. So we think that we can game the system, that there's a better way to do this where we can limit our losses and maximize our gains by trying to find the best investment for us.
Right. And you make a good point about the more educated we are, the more likely we are to kind of fall into this trap.
Did that hit home for you?
Yeah, because I'm really educated.
You're so educated.
I've lost a lot of money. Or I'm not very smart, and I made a lot. I'm not sure which one you're thinking of with me, but at any rate, it doesn't really matter. What I was going to say, I actually was listening to another podcast. I listened to other podcasts of other financial people, and the guy was talking about, he was home in his backyard, and the guy next door, there's a fence, and the guy has a pool, and they can hear each other, but they can't necessarily see each other with the bushes and the fence. And he was listening to this guy talking to his pool cleaner. And he said, boy, the pool cleaner and this guy, they were obviously the smartest investors in the world, because they talked up a storm. They knew, they felt like they knew exactly what they're talking about, which is what I'm going to tell to you, which is if you hear things, it's kind of that water cooler mentality. You know what? It's not necessarily the pool cleaner that you want to take your advice from.
So the pool cleaner was telling the guy how to invest?
They were both. They knew more than anybody else. Now, they're not in the industry. They're probably not even very good investors.
What's the name of the podcast? Because I think that probably told the story a little bit better.
It was Hanson McLean. It was.
I'm gonna go. I gotta listen to that one, because this one was just. I'm like, what the pool cleaner is doing what with who? Then there's bushes.
Yeah, and they were trimmed a certain way, and then the gardener came over and he got into it. And then the grandchild came in and said, "No, I'd buy apples."
So he was eavesdropping on the pool cleaner.
Yeah,
I got it.
The point, though, I'll try to make it. The point was, everyone seems to have a strong opinion on what they should do.
Of course, yeah.
Yes, right?
And when they say with conviction, you have to believe it.
Of course, right?
It's like, oh my goodness.
So I actually. I found out where Scott Hansen lives, and so I'm going to
go over there and
go talk to the pool cleaner. That's the takeaway here.
Yes. Maybe we can hire him to be our chief investment officer.
He lives in Sacramento. Driving up, I'm going to go to Colorado first, run back to Sacramento.
Hopefully the guy's cleaning the pool.
Hopefully. I could wait a week. Probably, maybe every 2 weeks. I may have to stake it out for a couple weeks.
Oh, man. Well, I got to tell you, we got a show lined up for you today. I'll tell you that.
It's a show.
It is going to be a show. It is the weekend. It is Memorial Day weekend. Hopefully you're out and about having fun with friends and family. When we get back, the whole mantra of sell in May and go away. Should you do that? Well, we're almost hitting June.
Yeah, it's too late. You missed it.
Yeah. Well, it's probably sell in June, and I can't think of anything off the cuff there. All right, and then how about this presidential race? Should that influence your investment strategy. I know a lot of you are probably freaking out and saying, oh my goodness, if this person gets in, what am I going to do? Should I get in the market? Should I get out of the market? So we can have a discussion around that.
Yeah, I got one coming up. Americans say this is their top financial regret.
Ooh.
So we're going to figure that out.
Listening to Your Money, Your Wealth.
So that hour that I wasted.
Yes, right. Oh, boy. All right. Hey, we got to take a break. We'll be back in a second. Show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson, Big Al. Happy Memorial Day weekend. Go to purefinancial.com if you want more information about our firm. And here's an interesting statistic I got from MarketWatch here. Since 1950, a 60-40 bond portfolio, and if you just invested in the indexes,
okay,
right? So, just fully diversified 60-40 portfolio, let's say.
Okay, all right.
Hasn't had a loss in a 5-year period. Did you know that?
I did not know that.
So over a 5-year period, it all recovered on a 60-40
in other words,
period.
any 5-year period.
Any 5-year period. And then they did a rolling 20-year period since 1950. The worst total return for a 60-40 portfolio was 6.4%.
Really? Okay.
Not bad.
Not bad.
So you take a look. You have to take a look, of course, over the long term.
Right.
And I think just to kind of piggyback on that segment that we went through last just a few minutes ago, is that
I thought you
got to look at the long term. So, but the problem is that I'm retiring, right? I'm retiring next year. I don't have time.
Right.
But you do have time, right? It's crazy. You have another 30 years.
Yeah, and I think that's what a lot of people don't realize. Let's say you retire at 60. I mean, you may live till 90 or 95.
Easily, I think.
Yeah, I mean, especially these days with modern medicine advances and people are eating better and staying more healthy.
Right.
Now, if you're one of those that eats a lot of bacon and,
Well, bacon's good.
Depends what study you look at, I guess.
But bacon, you can't eat a lot of bacon?
No, not carcinogenic.
Oh, whatever.
And fat.
Well, there's
did I blow your whole diet?
The whole fat diet, right? They told me to eat a lot of bacon.
Got it. Well,
Yeah.
You need a new doctor, nutritionist. Supposed to have 80 to 90% of what you eat is supposed to be a green vegetable.
No, whatever. That's boring.
It is boring.
Yes, very. All right, hey, we're talking about things that you can't control, and one of them is the president election. We cannot control I guess our vote can, but one vote, I mean, I suppose people tout about, hey, your one vote could be the turning point.
Right.
But should you change your whole investment philosophy? Because November's right around the corner. We're going to figure some stuff out. And what do you think there, Al? Should I get out? Should I wait to see what happens?
Well, we would tell you that the presidential election, historically, there's not much rhyme or reason, and you should probably figure out what kind of investment you should be in and stick to it, whether, through the election period. So that's what I'm going to say. What does your little article say?
Well, no, what do you think with Bobby Gavari and I went through a huge study, and they took a look at rolling periods after rolling periods of who was elected, not elected, and what did the stock market do and everything else. So do you think the stock market performs better or worse if there is, let's say if a Democrat gets elected in office.
Yeah, like the following year.
Well, let's say a Democrat gets elected this year, right? And I'm not predicting anything, but if you look at past, you got a Democrat in office, do you think the market goes up or down?
It goes up.
Republican, do you think that the market goes more up or more down than when a Democrat was in?
Yeah, I think I've already seen that. It doesn't go up as much.
Right. Well, it's funny.
Yeah.
Because when a Democrat is in office, according to certain studies,
sure,
right?
Yeah.
We're not saying we're Democrat or Republican. We're not getting political here. But I think a lot of times people say, man, if this person gets into office, I don't know what I'm going to do. I'm going to sit into cash and I'm just going to buy gold or do whatever because everything's going to go to hell in a handbasket.
Right.
Right. And I think everyone has these same emotions every single election year, right?
Sure.
Because it seems to me no one really likes anyone to get into office every single year.
Well, whoever gets elected, at least half the people think that was a bad choice.
Right. At least half.
Yeah.
Sometimes more.
Usually more.
But then how did they get elected? I don't know. That's another story. That's another show.
Because the independents and people that didn't vote.
So
how about that?
There you go. But so here's the deal: is that all right? The markets don't like uncertainty. And I saw this study recently. It was an article that was written, and I'm not saying that this is what's going to happen, but they said, all right, well, here, if a Democrat gets elected, let's say if Hillary Clinton is the nominee, right, and so she gets elected president, then it's basically Obama administration part 3. Yeah. So a lot of different things wouldn't necessarily change, if you will, right? Because it would kind of be the status quo. So the market wouldn't necessarily jumble as much. It wouldn't be as volatile as we get through the election.
Right.
If Trump gets in, I think there'd be more volatility because, well, you know, he's kind of a wild card in the sense.
So it sounds like you're predicting.
I'm not predicting anything. I'm just referring back to what this individual said. And it made sense to me because we don't know who's going to get elected. And so prior to anything, it's a 50-50 shot. It's going to be either, you know, a Republican or Democrat at this point.
We think.
Yes, we don't know. We don't know. But I guess the point is that you got to look at the long term. Right? You got to take a look and say, all right, well, here, I have to invest. I have to achieve a certain rate of return to make sure that I can focus on my specific goals. And if you can make it on your goals on 2%, because that's what the 10-year Treasury is, it's under 2%, right? It's like, okay, well, then here, buy the Treasury and then take your 2% risk-free and you're good. But that's not the case. Most of us need some sort of risk. We need a 5%, 6% rate of return. And so what does that mean? You have to be in equities. You have to buy real estate. You have to be investing internationally. You probably have to have some emerging markets in a globally diversified portfolio. The case is that you need, let's say, 6%. You're not going to be able to do it sitting in cash. And if you sit in cash and wait for the election to go over, you could miss a huge bull run, or you could get lucky and say, you know what, I was smart, because now the big bears come out.
Right.
We just don't know what's going to happen. So you have to be a defense mode and look at, all right, well, here, what is the probabilities of me achieving success with the investment strategy that I have right now over the next 30 years?
Yeah, well, that's right. And so I guess here's what history tells us, is there's not much rhyme or reason in presidential election years, or any year for that matter. I mean, people are always trying to have correlations to certain events, and yeah, I'll tell you what, case in point, last presidential election. So we had, if I got my memory right, I think that was the year where the U.S. got downgraded. So we had that issue. And then it was like, man, Obama might win again. We might have a Democrat for another 4 years. And guess what? The fiscal cliff, that was coming up. And so we're going to have much higher taxes. And if there was ever a case for fear, I guess, it might have been that. But you know what happened? The downgrade didn't really affect things that much. We averted the fiscal cliff by changing the tax law, and Obama got elected, and the stock market went way up. So there you go. It's just awful hard to predict these things. And so here's my advice, is the presidential election year or not, it doesn't matter. You need to just get the right investments for you and stay invested, rebalance when you need to. But that's the bigger point here. And whether you sell in May and buy back in, November, you know what? We talked to Larry Sweater about that. There is some evidence that says May through November it's not quite as good of
right. But what's
investing.
The alternative? Is what you have to consider.
That's what he said. I mean, it's like 1% or 2% lower than the rest of the year. Why is that? It could be random. It could be significant. Who knows? But the point is, it's still the better investment compared to anything else. So what's the alternative? Is right.
Yeah. So what is the alternative? So if you sit in cash, and let's say that your globally diversified portfolio did 3% versus the cash is paying you 0.3.
Right. Yeah. Or it did 4 instead of 6, or it did 7 instead of 10, whatever.
But then
right?
someone's saying, well, how about if it does negative 20 and then I'm sitting in the cash? I did good. Well, yeah.
Of course.
But then when are you going to get back in?
Yeah, that's the problem, right?
That's a problem. And if your entire portfolio was down 20, 30, 40%, and I hate this. I hear these people too when they're like, oh, you're going to just remember 2008 when you lost 50%? Well, those individuals then had to have 100% of their assets in the S&P 500.
Right.
You know, how many portfolios do we look at?
Yeah,
thousands.
Lots.
And I maybe on the count of one hand, I've seen one person come in that has 100% of their assets in the S&P 500. You know?
Sure.
Most people have a little bit of diversification. It's probably not as sound as it should be, but that fear tactic drives me nuts. Oh, when the market goes down 50%, are you going to be one of those persons? Well, here, you need to buy this particular product or come work with me because I can save you from that. No one can save us from a 50% drop.
Right.
You know what I mean? So if you got lucky enough to time it and get in the cash, perfectly. Great. But when do you get back in? Because I'll tell you what, Al and I were on the radio show in 2008. 2009, 2010, and people would call in and still think that, we're in for a double dip recession, right? Because they wouldn't believe that we're still, that the bull market was here.
Yeah.
It was several years after the crash of '08 that people finally got back into the overall market, and they missed probably 100% run.
Yeah, it was. I think I was reading that this has been the second longest bull run in the history of the stock market.
And the markets will crash. I can guarantee you that.
We know that.
Then you have to ask yourselves, what are you going to do? Right?
Right.
Are you going to get into cash, or are you going to be smart about it to make sure that you have the right portfolio now before it happens? All right, we got to take another break. Show's called Your Money, Your Wealth.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson, Big Al Clopine. Happy Memorial Day weekend, everyone.
So, Joe,
Yeah.
Americans say this is their top financial regret.
Well, since it is Memorial Day, and we are American,
Yes.
let's see what the top regret is.
1,000 Americans were surveyed.
All right.
Study from Bankrate.
Bankrate.
What do you think? What do you think the number one financial regret is?
Not saving enough.
You are correct.
Oh, my God.
Not saving enough in retirement.
Wow, what a tease.
18. You ruined the whole thing. Chosen by 18%, but do you know what the second most common?
All right, so number one is they didn't save enough. Number
Yes.
two is they did not seek professional advice.
Yeah, I don't think that made the list.
Oh.
But
They didn't spend enough time with their family.
this is financial regret.
They,
How about this? Not saving enough for emergencies.
well, it's the same.
Oh, it isn't.
Not saving enough.
Yeah, but there's a difference between saving for retirement
Oh, okay. So they
and saving for
all
emergencies.
right, here's the top 5 regrets. I didn't save enough for my retirement. I didn't save enough for my cash reserves. I didn't save enough for college education.
You wanna know the
I
third
didn't
one?
save enough to buy home goods because I put it on my credit card. What?
Number 3, too much credit card debt.
Oh, see?
I didn't save enough money to pay off my credit cards.
Yeah, right.
And how about this? 17% said no regrets at all. I
Well,
would do it the same way.
they're lying.
So there you go. Okay, are we done with the segment now?
Yeah. Here, all right, I got a couple quick things here.
Okay.
Take control of the 6 biggest retirement expenses.
Okay.
All right, so when you take a look at retirement, if you've been a listener to the show, we talk about all sorts of different statistics when it comes to the lack of retirement savings that a lot of individuals have. So you got to get creative when you go into retirement. And one of the biggest things that you can do, right, is reduce your expenses. If you don't have enough money to maintain your lifestyle, well, something's got to give, right? You're going to have to continue to work, save a lot more money, or reduce your spending, or you do a combination of all 3. Number 1 here on the list is that you can control housing, because housing still remains one of the largest expenses, Alan.
Yeah, according to this article on U.S. News, they're saying that people over age 50 spend an average of 40 to 45% of their household budget on housing and housing-related items. So it's not just the mortgage payments and property taxes, but it's your insurance and utilities, it's your home furnishings, gardening, other yard expenses, it's fix-up, it's a new roof, it's all that stuff is it's pretty expensive. And when you think about retirees, now those that of course listen to our show, they've got plenty of savings, and so they've got a bigger budget, but many don't have a big budget, and so the housing as a percentage of what's available to spend in retirement becomes a much bigger number.
Right, and I lived in the condo world forever, and I always like, man, this HOA, it stinks, man, it's so expensive.
Yeah. And now you got your house.
Then you got your house, and then you're like, wow.
Maybe that was a better deal.
The HOA is dirt cheap. Right? Because you got
Gotta pay for all this
you
stuff,
got all
right?
sorts of, my
Yeah, you
gardener's MIA, I got weeds going,
Yeah.
Healthcare is another thing.
True.
We're doing a webinar on Medicare coming up here with Dr. Katie.
Oh, yeah.
And so we're going to dive in deep into Medicare. She's been on the show a couple of times,
You bet.
and she's really making a name for herself as one of the nation-leading experts when it comes to Medicare. And I think a lot of people are overspending in some areas when it comes to their insurance because they don't necessarily know what they should have. Should I have a Medigap policy or not? Should I go to Medicare Part C, Part D?
Oh,
What-
it's very confusing.
Oh, it's crazy, and it's like, okay, well, here my wife is, or my husband is still on is still working, so I'm still on their coverage. Do I have to file for Medicare? And then am I doubled overlapping? So there's a lot of different things that you want to know. We could spend 2 hours talking about it and bore the heck out of you. But what we decided to do instead is do a webinar on it. So you can watch it in the luxury of your own home. Go to purefinancial.com. Just go to the Learning Center there, and you can sign up for that webinar. The third one on this list here is big, taxes, right? Because we talk a lot about taxes, and I think when you look at your overall retirement, what are you doing right now to save money or set yourself up where you can potentially reduce your taxes?
Yeah, because the problem is for many, the bulk of their savings is in their retirement accounts, their IRA, their 401k, their 403b.
So I got an email, right?
Yeah.
And he's like, Joe, hey, love you and Big Al, but this Roth conversion
makes no sense.
Makes no sense. I don't get it.
He did say we were smart there.
Yes, he goes, well, what did he say? I'm an advanced
investor.
Advanced investor.
Yeah.
But you guys are sharp. I was like, all right, thank you.
So it caused us to read the whole thing.
But yeah,
start with a compliment.
He was good.
Yeah.
Right? But I understood where he was coming from. He's like, okay, well, if I have $100,000 and I convert it, and he's using the different rates. It's like, well, if I convert it, $100,000, I have to pay 30% in tax. Okay, now I have $70,000. If I don't, I still have the $70,000, right? So if you look at it in a silo with just kind of some simple assumptions, it basically kind of breaks even. But that's nowhere near from the truth if you put it together with different strategies.
Yeah, well, and the reason is because if you assume that you're always going to be in the same tax bracket, right? If you assume tax rates never go up, if you assume that you never have a need for cash where you have to pull it out of your IRA, causing you to go into a higher tax bracket, if you assume your spouse is never going to pass away, because that's if he or she does, you're going to be a single taxpayer with different tax brackets. If you assume that your kids, right, their tax bracket, they may be higher than yours, and all kinds of, there's a lot of factors that go into this. But Joe, I would say most importantly is this: when you're in retirement and you have the ability to control your taxes by deciding how much should I take out of my IRA, how much should I take out of my non-retirement accounts, and how much should I take out of my Roth IRA, then on a year-by-year basis, I can control taxes no matter what they become or what they change to. I can always control at least the upper level of my income by having that be either tax-free or capital gain. But I have to have some diversification in taxes because, gosh, we talk about investments, be diversified with investments, but you also have to be diversified in your taxes as well.
Right, because if you look at it, and let me give this example again, is that let's say you have $100,000, right? And you're like, okay, well, here, if that was in an IRA, okay, I got a deduction for that. So the full $100,000 totally invested, and then when I pull the money out, I'll have to pay the taxes on the back end, and let's assume a 30% tax rate.
Right.
So when I pull the money out, I have to pay 30% on the 100, so I net out $70,000. Or I can say, let's convert the $100,000 into a Roth. Okay, so now I have $100,000 in the Roth, but wait, I got to pay $30,000 in taxes to do it, or 30% in taxes if we assume the same tax rate.
Sure.
So I have $70,000 in the Roth. 70,000, 70,000, same. If you just look at the numbers like that. But what I think they're missing is that 70,000 now is in a Roth IRA, and every future dollar is going to grow tax-free. And as that account grows, right, so all of that percent gain is going to be yours tax-free. And as that account builds, right, that means more dollars are in that overall account. And if you want to clear out the overall account with a lot larger dollar value, right, what's going to happen to your tax bracket? It's going to blow up the tax bracket because the tax brackets are marginal. A little bit is taxed at 10, 15, 25, 28, and so on. Right? So the larger the balance, the more tax potentially you're going to pay depending on what your distribution strategy is.
Yeah, and Joe, the more money that you have in your IRA or 401k causes a higher required minimum distribution. And guess what? That distribution generally increases year by year because you don't have a shorter life expectancy. And I think the basic miss from a lot of people is they don't believe they have any control over paying their taxes, but it's not true. Because in retirement, you have more control over how much you pay in taxes than any other time in your life. But you may not be getting this advice from your accountant because your accountant generally looks at 1 year at a time, and you're probably not getting this advice from your advisor because they're looking at investments. So, and it may not be their expertise. The only way to lower your taxes is by having a forward-looking, tax-efficient strategy.
All right, we got to take a break. Show's called Your Money, Your Wealth. We'll be back in just a second.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson, Big Al Clopine. Thanks for tuning in. Go to our podcast, iTunes, Your Money, Your Wealth there. iTunes, Your Money, Your Wealth, or go to purefinancial.com to get a little bit more information. So we talked a little bit about this earlier, Big Al, but the sell in May and go away. It's a pretty popular phrase. We are in May. But the third quarter of the year does tend to have the greatest volatility and lowest returns over time. But staying invested is the smartest approach. This is by the street. So get this. Since 1980, the S&P 500 has had a total cumulative return, assuming the reinvestment of dividends, of 4,958, or roughly 11.5% annualized.
Okay.
By the way of comparison, the same 1,000 invested on 1/1/1980, but moving assets to cash on May 1st of each year, and then re-entering the market on November 1st, your annualized return would have been about 8.5. So that's 3% annual difference. Compounded means that your total return would be less than 1/3 of the simple buy and hold with dividend reinvestments. Instead of the $1,000 investments growing to $50,583, it would have grown to only $16,755. So the clear catalyst behind the significant outperformance is the reinvestment of dividends, as well as the fact that the month of May has historically been kind to investors. So when you look at dividends, since 1980, May has brought positive returns to the S&P 500 nearly 80% of the time.
Okay.
So 20% of the time, it stinks.
Yeah.
Right? Dividend reinvestment accounts for nearly 40% of the total return of the S&P 500.
Really? Okay.
40%. So look at a couple of different products that are out there. And I want you to be clear about what some individuals, and especially on this radio station, across the country, talk about certain products that you could get stock market returns with zero risk. Well, with those products, there's no dividends. And if the S&P 500, right, 40% of the overall total return of the S&P 500 is dividends, you don't get that 40%. So, all right, so that's 40% cut. Plus, there's participation rates in some of those different products. And I think people hear it all the time. Hey, how would you like stock market returns with no downside risk? Hey, we could be facing another 2008 right around the corner with all this quantitative easing, and then this big bubble is going to burst and everything else. Hey, that truly could happen, right? But is it to go into a product to lock yourself up for another 18 years? I don't know if that's the right answer. So you have to be a little bit smarter and say, okay, well, how does this product actually work if you really think that you can get stock market returns with no downside risk? They don't include dividends. There's a participation rate, and there's different point-to-points that you have to consider when you are considering a product that sounds really good on the surface, but the delivery of it may not be as good as you may as anticipated.
So, yeah, so be careful. Buyer beware. Hey, Joe, I got an email from actually one of our advisors. A client or prospective client emailed, "Are you familiar with a company called," and I won't say the name, just company. "Heard a radio program, got interested, attended a seminar by them. They're touting a strategy to use a max-funded, indexed, universal life policy to build tax-free income in retirement, taking advantage of TEFRA 7702, DEFRA 72E, TAMRA 101A. Let's see, their strategy seems to offer an opportunity for growth without risk to principal." So we hear about those kinds of things.
Sure, and I think, I like how they go to the tax code there, because it's just basically saying that a life insurance contract is tax-free.
Right.
If you look at life insurance itself, it's a powerful vehicle from a tax perspective, because that death benefit is 100% tax-free to the heirs. So that's a really good thing.
Yes.
Right? Building up cash value in an overall life insurance policy is another thing entirely, right? And especially with an indexed UL policy, because there's different costs and fees involved with that. Same with that indexed UL policy, they don't get dividends, right? So 40% of the overall return of the market you don't get, plus whatever participation rates and everything else. But what they're saying is true to some degree.
Yeah,
you put money into the policy, you let it grow tax deferred. You're not going to pay any taxes when you pull the money out, and you're in this index type product where there's no downside volatility. You will not lose any money because it's a fixed rate, and we're going to try to get you a higher rate of return than maybe what the fixed ledger is going to pay out within the life insurance company.
Yeah, because the idea with a life insurance contract is you can, in a sense, you can overfund it. You can put more money than what is required for the life insurance, and so it builds up a cash value.
Well, no, you can't necessarily do that because there's a corridor that there's got to be some level of insurance,
well,
right?
So let me clarify. You can't go hog wild. I mean, there's limits to how much you can do, but you can put a certain amount over and above the life insurance cost.
Yeah.
And that allows you to invest inside this policy, and the IRS says that it's tax deferred. And furthermore, if over time that investment per se inside the life insurance contract, if it grows greater than the cost of insurance and other costs inside this product, then you've got a value, an investment value that you're allowed to borrow against, and that's where they get the tax-free part, right? You can take a tax-free loan, borrow against it. There's issues if the product. If the contract lapses, you have to pay the taxes and all kinds of things.
Right. So let's look at the concept though. And I like the concept. I just hate the product and the strategy.
Right.
Right? Because there's a lot better way to do it, and I'm going to explain it in a minute 30. Right?
Okay.
Is that here? Because if I'm going to fund something like this, to say, hey, I'm going to put cash into a product that's going to grow tax deferred for me, right? And then potentially I can pull it out tax free.
Yeah.
What I'm funding those dollars with is what? After-tax dollars, correct?
That's correct.
And so let's say they want me to put a whole bunch of money into this overall contract, such as $10,000 a year, $20,000 a year, $50,000, $100,000, one lump sum, whatever, and it grows tax deferred. Okay, so that's after-tax dollars that has to go into that overall product. Okay, and then now you're in this big shell of insurance, so you have a cost of insurance that you have to pay for. There's fees and costs for the administration of the overall policy, right? If you die, great, because now you have this big fat life insurance policy, but you don't buy, they're not selling it for you to die. They're using it as a way for you to fund your retirement income tax-free, right? That's the pitch. So why don't you do this? You have an IRA, you have a 401k, right? You probably have dollars in there that was pre-tax that's never been taxed. Why don't you convert those dollars into a Roth IRA and kill out the middleman, right? So you don't have all the fees and cost and everything else from this big life insurance, right? It's going to run the same, but now it's in a Roth IRA that will forever grow tax-free. Right, with half the cost.
Yes, I totally agree. So that really, and many advisors, including ourselves, will tell you, for your life insurance part, get term insurance.
Unless you have a special needs child.
Oh, sure. Yeah.
So there's room for permanent insurance.
Of course.
I don't want to label. I don't want to give advice.
Okay.
There's pros and cons to each, I guess, right?
All right. Fair enough.
But I think we would lean more towards.
We would lean towards that in most cases.
Yes.
Would you agree with that?
I would agree with that.
And then do your investing separate from your life insurance. Now, you're right. Some permanent policies, charitable remainder trust, or special needs kids, or things of that sort. Sure, absolutely. There's a place for it.
Right. So you just want to make sure that you take a look at the pros and cons of each of anything that someone's going to position to you.
Right.
But the problem, I think, is where you're alluding to is that, all right, well, here, this solution sounds really good. Right? Because I don't want to pay taxes. I want to grow the money tax deferred. And then they kind of
I got no downside risk.
And I have no downside risk, right? I can invest it. I don't have to lose anything. Well, I think hopefully our listeners are a little bit smarter that there is no holy grail of investing. Risk and expected return are related. And the best way to do that, in our opinion, is to say, all right, well, if you want tax-free growth, go with the Roth IRA. You can go life insurance, sure. But I'm telling you, you compared that strategy to a strategy I come up with that's saying, all right, well, here, you're going to pay tax to get out of this retirement account. You paid tax already to fund this life insurance, so that's going to be the same. Now the money's sitting into a Roth IRA in a globally diversified portfolio, in a low-cost portfolio, versus embedded in fees and cost and infested with all this other crap inside this insurance contract. Give me 10 years, I'll tell you who's going to win, right? But my strategy, that's not full of commissions. That strategy is full of commissions, right?
Yeah, full of a lot of hidden costs.
Yeah.
Yeah.
So
Okay.
anyway, whatever. So, I mean, the fact of the matter is that, there's a lot of things that sound pretty good. Just do your due diligence. Just trying to figure out, all right, does it make sense for me? Is it appropriate for me? And if you want our help, if you want a second opinion, we'd be more than happy to give it to you. Go to purefinancial.com. We got to take another break. Show's called Your Money, Your Wealth.